Hi guys, Assalamualaikum warahmatullahi wabarakatuh. We are from Group 1, D1AC1105A, and before we begin, let me introduce our group members. The first one, our group leader Ahmad ZULFAKAR bin MZ Ahmad THALMIZIE, and the second one, me myself Ahmad ZAIM YAZDAN bin YATIM, and the third one, Akmal AIDI bin Ahmad alias Ahmad ALWI, and last but not least, Muhammad IKHWAN bin RASHID.
IKHWAN, what are you doing?
Oh, I am studying about investment appraisal.
Oh, investment appraisal. Actually, I don't quite understand that topic. Can you explain it to me?
Alright, I will explain it to you. Let's go!
Alright, so what is investment appraisal? Investment appraisal is the application of financial techniques to assess the profitability, risk and viability of capital investment proposal by analyzing expected future cash flow. It also refers to the process of evaluating long-term investment projects to decide whether they should be accepted or rejected, with the aim of maximizing shareholder wealth and ensuring the efficient use of limited resources. So, we will continue to the objective of investment appraisal. The first one is to select the profitable projects. The second one is to ensure efficient allocation of capital. The third one to maximize shareholder wealth. The fourth one is to assess the risk and uncertainty. And the final one is to support long-term strategic decisions.
Okay, next I will be talking about the case study background. Whether ZAIM Life Syndrome should replace its existing machine, giving a 10% cost of capital and a 24% corporate tax rate. Investment choices are more important since there are more required a large initial investment and have a lasting impact on a business competitiveness and profit. In order to boost productivity, lower operating costs and boost sales, ZAIM Life Syndrome is thinking of replacing its current 5-year-old production equipment with a new high-tech device. Based on a 10% cost of capital and 24% corporate tax rate, this paper assess the feasibility of the suggested replacement project using investment appraisal method from MAF253.
So, let us go to the initial outlay. So, what is the meaning of initial outlay? Initial outlay refers to the net cash invest required at the start of the project. So, before we start our case study, let us go to the working first. So, depreciation of old machine requires a formula that is purchase price minus service value divided by useful life. So, after we calculate, there is depreciation per year, that is 80,000 divided by 10 years equals to 8,000. Accumulated depreciation, that is RM 8,000 multiplied by 5 years equals to 40,000. So, as for the net book value of old machine, that is 80,000 minus 40,000 equals to 40,000. So, the profit or loss on disposal of old machine needs the formula of sales proceeds minus net book value. So 31,000 minus 40,000 equals to negative 9,000. That means there is a loss on disposal that is amounted by RM 9,000. For the next working, there is about depreciation of new machine. So the purchase price is 150,000 less service value, that is 80,000. Depreciation amount is 17,000 and the total of depreciation per year is 70,000 divided by 5 years equals to 40,000. So next, how do we get tax gain due to disposal of old machine? So the formula is tax percentage of tax rate multiplied by loss on disposal. So 9,000 multiplied by 24,000 equals to 2,160. So how do we calculate increase in depreciation? So the formula is depreciation of new machine minus depreciation of old machine. So 14,000 minus 9,000 equals to 6,000. So now, let us go to the initial outlay. For cash outflow, price of new machine that is 110,000 will be adding capitalized expenditures such as installation cost and transportation cost. That is the total of 40,000. So the cost of new machine is 150,000. It will be minus decrease in material, that is 25,000, and also adding back by decrease in account payable, that is 20,000. It will be less cash inflow such as sales proceeds, that is 31,000, and also tax gain on disposal is 2,116. So the net initial outlay is 111,140. So now let us go to annual differential cash flow. So for the working is under benefit, there is decrease in production cost, that is 88,000 will be multiplied by 10% equals to 8,800. Next is increase in sale, 24,000 multiplied by 12,000 equals to 28,800. So the total of both is 39,600. Will be less by cost, that is increase in depreciation, that is minus 6,000. So the total before tax is the net profit before tax is 31,600 less tax, that is 31,600 will be multiplied by 34,000. So the tax is minus 7,584. So will be added back by depreciation, that is 6,000. So the total of annual differential cash flow is 30,060.
So now let's go to terminal cash flow. So as for terminal cash flow, there is salvage value, that is 80,000 will be adding by decrease in material and minus decrease in account payable. So the total of terminal cash flow is 85,000. So let's go to the payback period. So to calculate payback period is initial outlay divided annual cash flow. So as for the calculation is 3 years plus 21,792 divided 30,016, so equals 3.73 years. So next we go to net present value. So the formula of net present value is cash flow multiplied by present value in future, that is PVIF. Next is net present value, that is for the formula is initial outlay minus present value. So the total of net present value is 41,385.7168. So lastly, we go to initial rate of return, that is IRR. IRR, that is lower rate plus NPV lower divided by NPV lower minus NPV at higher rate multiplied by higher rate minus lower rate. So the total of IRR is 22.85%. So therefore, the company should replace the old machine because the NPV is positive and the IRR, that is 22.85%, is higher than the required rate of return of 10%, and the payback is lower, that is 3.73, then targeted payback period, that is 4 years. Thank you.
Assalamualaikum.
Sir, may I ask some question?
Yes, what is it?
Actually, I have heard that SME enterprise project is around the corner. So
But I don't know actually what is SME enterprises. So can you explain to me what is SME?
Oh, you don't know about that?
Let's go!
Generally speaking, an enterprise is any form of organized economic activity that is authorized to perform act of commerce for the purpose of obtaining profit under competitive conditions. However, in a business and regulatory context, we need more specific criteria to classify them. In Malaysia, the National SME Development Council established standard definitions to ensure consistency across all government agencies and financial institutions. These definitions are based on two primary criteria, which is the number of full-time employees or the annual sales turnover. An enterprise is classified as an SME if it meets either of these thresholds. The specific classification depends on the sector the business operates in. For the manufacturing sector, an enterprise is an SME if it has no more than 150 full-time employees or an annual sales turnover not exceeding 25 million. For the service and primary agricultural sectors, the thresholds are lower, with a maximum of 50 full-time employees or an annual sales turnover of no more than 5 million. The SMEs are further categorized into three tiers based on their size, which is micro, small, and medium. For example, a micro enterprise across all sectors typically has fewer than 5 employees. Why is this definition so important? It's because SMEs are truly the backbone of our socio-economic progress. In most economies, they represent over 99% of all business establishments. By understanding exactly what defines an SME, we can better appreciate their unique challenges and the vital role they play in driving innovation and creating jobs. Now that we understand what an SME is, we must address the reality of operating one in Malaysia. According to our research, there is a staggering 60% failure rate among Malaysian SMEs within their first 5 years. To understand why, we have selected 3 critical issues identified in the literature. The first and most persistent issue is the access to credit. Even though the government provides various funding schemes, many SMEs face a chronic insufficiency of resources. The problem is twofold. The first one is risk aversion. Most banking institutions are risk adverse. They prefer lending to large, established corporations rather than SMEs, which they perceive as high risk with weak expected returns. The second one is collateral requirements. Many startups lack the assets required to secure traditional loans, leaving them in a financial squeeze during their critical growth phase. Secondly, we found a significant gap in management skills. This is an eternal issue that directly affects the financial health of the company. Many SME owners rely solely on personal experience and lack formal training in financial management. This leads to an inability to develop formal business plans or maintain computerized financial records. Without these records, it is impossible to perform an accurate investment appraisal, which is a core requirement of our project today. If the records are poor, the relevant cash flows we measure will be inaccurate, leading to pure investment decisions. The third issue is marketing deficiencies. Survival in modern economy requires more than just a good product. It requires branding and customer loyalty. Many Malaysian SMEs lack knowledge regarding international marketing networks and branding. This limits their ability to compete with larger firms and prevents them from expanding beyond their local neighborhood, ultimately hindering their long-term sustainability. In conclusion, these issues are interconnected. A lack of management skills lead to pure financial planning, which then results in bank rejecting credit applications. As a professional advice for our assigned project, we recommend that SMEs restructure their financial systems and adopt standardized investment appraisal technique like the NPV and IRR methods we are presenting today. By improving the accuracy of their financial data, SMEs can overcome the risk perception of banks and secure the funding they need to survive past that 5-year mark.
Okay, next I will be talking about the investment appraisal process for SMEs. The first one, company identifies the project, such as replacing an outdated machine to reduce costs and increase sales. Next, the firm estimates relevant cash flow, including the initial investment, annual operating cash flow, and terminal cash flow. And then investment appraisal technique learned in MAF253, such as payback period, net present value, and internal rate of return IRR are applied to evaluate the project. Finally, the company makes a decision by comparing that result with its objective and cost of capital to determine whether the investment should be accepted or rejected.
So, the decision making, Zainlah Senjang Berhad should replace the old machine because the first reason, the project show a positive net present value that by replacing the old machine, it adds value to the company and improve its long-term financial performance. The second reason is the payback period for the project is 3.73 years, which is shorter than the target payback period of 4 years. Therefore, Zainlah Senjang Berhad can accept the project. And the last reason is the internal rate of return IRR of the project is 22.85%, which exceeds the target rate of 10%. Therefore, the project is acceptable under the IRR criterions.
So, in conclusion, small and medium enterprise SMEs plays a significant role in economic growth but commonly face challenges such as limited access to credit, insufficient financial resources, and weaknesses in management and accounting skills. These issues increase the risk of poor investment decisions and highlight the importance of proper financial planning and analysis for SMEs. Investment appraisal is therefore essential as it enables businesses to evaluate the costs, benefits, risks, and viability of long-term investment projects using systematic financial techniques. In the case of Zainlah Senjang Berhad, the application of investment appraisal method provides clear and reliable guidance for decision making. The project demonstrates a payback period of 3.27 years, which is shorter than the target of 4 years. A positive net present value indicating value creation and an internal rate of return of 21.38%, which exceeds the required rate of return of 10%. So based on these results, it is advisable for Zainlah Senjang Berhad to replace the old machine as the investment improves operational efficiency, reduces production costs, enhance cash flows, and strengthen long-term financial performance. Overall, this case study shows that effectively investment appraisal help SMEs overcome financial constraints, reduce risk, and make informed decisions that support sustainable growth and business success. That's all from us. Thank you.